mid-April, guys. So it's earnings season. I think Carl brought up an interesting point in the trading room. We might get some good earnings based on some of the tax benefits from the new tax reform that's taken place. So this is the first quarter we might be able to see some decent results. With the geopolitical head, before we get to these B2B bars that we're going to talk about as today's topic, geopolitically, you have those the whole thing in Syria over the weekend. You still got another shoe that could always drop in the Trump investigation, and yet we're up and away. It seems like they're dodging these headwinds lately the last few sessions, and we keep opening up higher where we close. We rally, and the market is shrugging off concerns that there's something else to drop in that whole Mueller investigation. Where it was left off last week is and not to beat a dead horse, but they raided his personal attorney's office. What's developed from now or from then till now hasn't been anything that ties back so far to Trump. That could always happen. Don't let it surprise you. If you're in front of your screens, you know the knee-jerk reaction. And again, just don't let it surprise you. That could be the what's next question that should be asked. If the smart money, meaning the markets, thought there was worry about this whole investigation, I don't think we'd be in the 2700s like we are today in the S&P. So earnings are kind of strong, could be tailwinds to equities. Fed speak can drive us if some doves are a little hawkish, hawks are a little dovish. But right now, they're pretty much set on 2 more rate hikes for the rest of the year. If they go to 4, it's bearish initially for stocks and bonds. But just to keep your eyes and ears on the headlines, right now the risk is another development. If Mueller thought it was something tied to the Russian investigation, I don't think he would have deferred it to the Southern District of New York like he did. I think it's something personal against Cohen, something that he didn't dot I's and cross T's. So market was real concerned about it. We'd be trading 25.50, not 27.05. That's about where we're at. So let's get into today's topic, B2B bars, part 2. B2B, just to recap, stands for either bullish to bearish or bearish to bullish, strong to weak or weak to strong. All right. And I gave it that acronym last June when we rolled this out. A better way to look at the same thing is always the theme of these meetings. So to recap, we know what they are. I just went over it. But when would you change them is important. Then your mind is following the transitional moments, and you could start giving your opinion as to what the market's opinion is. You know how I say, don't worry about what your opinion is, what's the market's opinion. That matters more. So you're not vested personally to the opinion. It's not yours, it's the market's. When would you change them is important. When would you go from bearish to bullish? If you watch them on ancillary markets, which is what we're going to go through today, does it lead? Does it give you a better picture? Now, a member of the room or a longtime Edge member trader talked about how it's really helping them keeping a snapshot on the NASDAQ, the Dow, the bonds, the yen, and the S&Ps instead of having to watch dome next to dome. Give them a better understanding where if you get a couple of them that are in bullish moments, the likelihood of going up is greater. Again, all we're trying to do is scrape away randomness as much as possible. When I traded in the pit in 1999, everything was random to me. The next price was always random. If I thought it was going up and it did, it was a guess, or it felt like a guess. I didn't have a leader. I didn't watch a leader. Didn't understand to look for a leader. And even though, and I told this story in the trading room today, I looked across the pit and everybody's eyes were on the board looking at the S&Ps. We were trading the Dow. They were looking for a leader, and that didn't even set in. So again, if you watch them on ancillary markets, does it lead? We're going to look at what that looks like on live charts in a moment. If your stop is obvious, then be careful. It's something I added to today's meeting. What do I mean by that? I said once before, if your stop is obvious, then don't take the trade. But I don't want to talk someone out of taking the trade if they're convinced it's going to go their way. So I don't want to change up what they're thinking too much. But if your stop is obvious, what does that mean? If the rest of the world would have a buy stop or sell stop there, it might be a magnet And there might be enough of them there to create a magnet. Let me show that with an illustration here. I can't draw as nicely as I do on the other screen share because I got to do everything by hand. But let's say the market is chopping sideways, and it's pretty clear to say that the longs are going to get nervous below that black line I just drew. If indeed there's enough longs that have sell stops down here where all these X's are, then there's a lot of sellers coming to the market. They're all trying to sell it up here, as we talked about again and again and again. Long positions are trying to sell it up there, up here, but they're willing to take a risk, a lot of them, to down there. Either way, if there's a lot of sell stops, then there's a lot of resting sell orders, and therefore maybe a lot of pressure on the market, maybe, to go get them and then maybe proceed north. So if there's just an obvious stop for you, it might be obvious to the rest of the world, and a lot of people have their sell stops there. And if there's enough, they're going to have to clear them before they go. And then you get stuck in, I get stopped out, and then it goes. I'm long, I get stopped out, lose a little money, and then it rallies. How many guys, and say yes in the chat if that happens to you a lot. You get stopped out, and then it goes. You get stopped out, and then it goes. You were right, but lost money. So that's going to still happen to you. You just try to minimize it. You're not trying to eliminate it. You're trying to minimize it. You're trying to understand it. Understand why stops are magnets if there's enough of them. And how they're going to have to clear. It's not the market taking it personal like it wants to just make you lose money. It does in a sense, but it's doing what a market needs to do in order to exist. In order for a market to accurately discover prices, that's what trading is, price discovery. It has to shake out too many longs or too many shorts. It has to always do its job. It's like a boat, and I've done an analogy on this, that has too many people on it. But if someone yells out, hey, there's 120 people on this boat, if 20 get thrown over we're going to sink unless we throw 20 over the edge. So what happens? There's going to be a shakeout of weak people. And guess what? They're going to overcompensate. They're going to throw 40 off. And everybody calms down. There's only 80 and the boat could float. That's survival of the fittest. That's a market doing what it has to do in order to survive as a mechanism to discover prices. That's what a boat and people have to do in order to survive. 100 people won't survive, but 80 will. They overcompensated because they were emotional. And that's how price works. You got to shake out weak hands. You're going to be a weak hand sometimes, but you want to minimize it as much as you can. So I added that line to this template. If your stop is obvious, be careful. Next, an exercise. If you worked for me, you traded my money, you'd be doing it, or you'd be fired. But nobody works for me, so I can't twist your arm and force you guys to do it. But review your day with them, meaning the B2B bars. Review it. Not every day, almost every day. Review your day with the B2Bs to see if you are calling them in a timely manner. That's how you get confident. Everybody wants to get confident by demo trading until their statistics show them to be profitable. You don't get confident by making money because you're expected to. You make money because you're confident. People want to make money and then think they're going to be confident. You got to get confident, then you make money. I'll say it again. People want to make money and then they're confident. You got to get confident to make money. You're putting the cart before the horse when you're trying to make money and then have the confidence. You got to have the confidence before you make the money. That's why when I've talked to people about education and they're like, I'm going to make some money and then I'll invest in this education. I said, don't bother. I said, if you're making money, you don't need to invest in this education. I says, you're trying to do it without learning, and that's fine. But don't circle back. Generally, that guy will never be back. He ain't going to make money. So exercise, review it. What do you review? I'm going to walk you through it in a second. Depending on your platform, everybody has vertical lines I think that they could stick in order to kind of show these transitional moments. I'm doing it as a mode of an exercise every day live in the trading room. I'm naturally doing it when you see me highlight the bars. Now I could go back without highlighting the bars and know when it's, or go bar by bar and know when they're transitioning. But let's not get ahead of ourselves. Let's go to some charts. S&P chart. Kind of a little noisy with these edge zones. It's in a drift, it's in a grind, it's bullish. But when does it get bullish? When does it get bearish? When are these transitional moments happening? And we'll go back to some that I put in here already. So right in here, around 9:30 Central, I had a bullish bar, not all the way at the top. I didn't put it in when it was all the way at the top. You could put it in once it takes out this red. When do you change them? A good rule of thumb is when you change, a good time to change a bullish bar back to bearish is if it takes out where it got bullish. Where did it get bullish? Somewhere in there, right? So if it takes that area out and comes down in here, you might want to go back to bearish. That's a good rule of thumb to follow. But the market prior over here to the left got bearish. Where did it get bearish? Right there. And if you take it back over here, you could see once it takes that out, it got bullish again. B2B. So this highlighted vertical line at the bottom sticks in there. And what you could do as part of the exercise I'm talking about is go and, when the day is over, go through it bar by bar. Look at the right side. You see a bearish bar. Am I right? Yes, for one rotation. Yes, for two rotations. It's bullish now. Yes. Am I right? It should come down to even half. I don't know if you see my cursor, but that's this green right in here. It does. It rotates. You see how you're getting confident by making the calls, by saying that I put the transition markers in a spot. And you really, if you're doing it for the right reasons, you can't be wrong. It's the market's opinion, remember. It's not yours. So don't put yourself in a position, say, I'm putting too many of these. You might be, but at least get in a flow with trying to stick in some sort of tandem, in lockstep with the market, with the thing you're trading. The market's your partner. Feel like you're on the same page with it. Sometimes the market doesn't know what it wants to do and it changes its mind a lot. That's not you being wrong. It's the market being crappy. So right in this moment, I like when it goes, to me, I like when it goes bullish to bearish. I usually think that some downside is most probable. Now it wasn't, but I'm not thinking that all the way up in here. Now I'm thinking, okay, I like it go bullish to bearish. Now I got people confused. The point is that the transitional moments help you follow what the market is thinking so you could stack probabilities. Now, if you review and go through when you put these on, you could see if you're in lockstep with the market and you're honestly seeing the probabilities. If you don't do this exercise, you're not going to progress. You're not going to use these efficiently. It won't happen. Your understanding of a market is going to be slower. For people that are listening and are in this meeting that it's the first time you're hearing about B2B, June of last year, and it's in the top 5 most popular videos in track 4. The first meeting I did on B2B bars is there. Watch it after this event. So now we know about the S&P. You get a sense these B2B bars are transitional moments from up to down, down to up, right? And we also know about ancillaries. The word I use is ancillaries, which is correlations. We understand there's sometimes an opposite correlation with the bonds and the yen to stocks. We understand there's a positive correlation in the same direction with the Dow and the NASDAQ and the Russell and the DAX, whether they're European stock indexes or U.S. stock indexes. It makes sense why two different stock indexes are going to chart similarly. All right, so the NASDAQ is over here on a footprint on the right. The S&P over here on the left. Would you say this is a transitional moment right there? Of course. Takes out some red edge zones, some good resistance, gets fast with some green. This sideways to up does not surprise me. Once I determine it's bullish in here, I don't have to wait till here, and I don't certainly have to wait till the 20s get printed up at this top X. Long down bar, long up bar, all that stuff. But takes out some good red edge zones in there. All right? So you'd have a transitional moment called in that circle instead of being surprised, oh, wow, it's 8 points higher, and now you're bullish. Too late. Should have already been bullish. Now you take this and say, what does the ES show me? This is just before I started the meeting, the top of the hour. So let's blow the ES up. What does the ES show me? Does it transition? Yes, right there. If it was bearish in here, now follow me, if it was bearish in here, which it kind of is, one other thing let me add. When you're looking at a smaller time frame like a 4 PNF, you're going to change, the market's going to seem like it's changing its mind a lot more because it is. It's going to change its mind less on a 12 and less on a 24 than on a 4. That's how you start understanding multiple time frames. All right, let me get rid of those drawings. But it takes a bearish move down inside that yellow box, right? Where does it get bullish again? Right at the top of the hour in there. You know it inside this yellow box. You don't have to wait till up here, or certainly till up there. Where did the market rotate back down and stop? Where it got bullish, back into that box. And it walked back north. All right? You had some confluence. The NASDAQ got bearish to bullish same time. How do you make that into a trade? If you're bullish maybe for another reason, or this was enough, you're looking to buy support. Because the randomness is stripped out, we should go higher. At least sideways to higher, and you should be able to manage your risk and take a trade in a good location on the right side. The side is up or bullish. The location and timing is back to where it got bullish, and the confluence is the NASDAQ did the same thing and had a B2B moment at the same time. And I could put global cursors on this thing, and many of the platforms people use, if you're not using Market Delta, have global cursors, so you could go and run the cursor at the same time. I don't want to do it. All right, I'll do it. No, I don't want to do it. Where if I move this cursor, it moves it all. Because then it goes on all my charts. I got a million of them open. But it's a good way to go and say, hey, are there transitional moments in more than one market? So then you look at the Dow, which I recently added to the trading room screen share on a 10 PNF. So the rotations are pretty decently looked at like this, right? And you could see that the Dow at around the 11 o'clock hour didn't have an obvious bullish transition. It wasn't bearish, though. It did move up. It was probably already bullish from in there, right? But I don't want to set rules up for you. I want you to set rules up for yourself and say, hey, 2 out of 3, and you could get confident. This could be the only part of your strategy. This could be another thing to plug in to increase the probabilities or reduce the fear. And that's all we're doing, is trying to reduce the fear so we increase the consistency. Making money doesn't come until you're confident, and confidence doesn't come until you're consistent. It'd be nice to make the money and then get confident. It doesn't work that way. You got to give yourself confidence. You got to manage your risk. You got to get consistent to get confident, to get profitable. Then you got to remain consistent and confident. But go through multiple markets And in case you're having trouble watching it just on domes as they're moving because they could be moving too fast, get good at the B2B moments. When I introduced that concept a year ago, June, people loved it. People were excited about it. It helped them. And I think mechanically adding it to ancillary markets will help get a better read and understanding as who has the leash is the phrase that I use. So Bruce, who's really been fascinated with B2B bars, especially doing them on multiple markets, said he's using it more to stay in a trade or go decision while in a trade. To stay in it or get out. When you see the other markets, this is Bruce talking, when you see the other markets start to break down, you could have a good lead to get out. And he says this is what I do in the dome, but it's harder to see it there for him and probably others. So the lead in the dome might be harder to spot than a transitional B2B moment in ancillary markets. If you get in because you got more than one market in a bullish mode, it's going to help the probability or the decreasing of the fear. The screen share, for those that are also in the trading room, which is most of you, is still the S&P in the upper left. The NASDAQ is still in the upper right. The crude oil in the lower right. But I added the Dow in the lower left. And then in here, I smashed down the filter so we still see it, but it made room for the YM or the Dow in there. So right now, I would look at the Dow breaking out, and I can't show my shaded box in GoToWebinar, but Dow is breaking down in here through this box or balance, right? And I keep you cautious from continuing to buying these green edge zones. Not saying to get you short. You just look at these edge zones and you say, hey, it worked once, twice. It could work 100 times. It's giving you a lot of opportunities with a head start to take profit several times already. Ain't going to work forever. But you got to get good at transitional moments. Now the Dow would have to hold. Here, just analyzing this. Take the box. The middle of the Dow are these O2s. You jump through O2, you'll jump in the ES. Kudlow's on the wires, by the way. See, it flashed away from the O2s. So it keeps you cautious from trying to stay long. And you see how we got led down? Now you're letting the mechanics hold on here. Kudlow right now is saying the U.S. would like to see Japan free trade agreement at some point. There have been discussions and consideration at TPP, but nothing concrete that's occurred. If you're using the mechanics to get you bullish or bearish, you're replacing fear or a filtered bias of your mind trying to get you to think what it wants to think. Because if you're long, your mind's going to want to try to find reasons to get out prematurely. If you're wrong and long, it's going to find reasons to keep you in because it don't want to admit that it's wrong. Does that make sense? So you're using objectivity and some mechanics to dictate your decision making instead of the emotions and the fear that otherwise will replace it. Ken says it works great in the Boone, but like with any treasuries, you need patience. Boone's a great market. You trading more of the Boone these days, Ken? Now, the overall context of this market is up. We know that. It's been grinding, making higher highs, led by the NASDAQ, then the ES, then the Dow. Right now is lagging. This won't make sense unless you incorporate it into an exercise of marking your transitional moments as you go through and then going and reviewing to see if the market did cooperate when you made those markers. Or go back so far that you don't remember what happened and go bar to bar and put your transitional moments in. So let's say I didn't have this one marked at 11 o'clock and I'm going it bar by bar. I would go and say, oh, right in here, I want to mark this. Why? Because it broke through the red and laid out some green. Be simple with your reason. Then you go and say, was I right? And the answer is yes. Now you're not guessing. You're using mechanics to make your decisions, to follow the price action and whether or not the market's predictable. When the markets are crap and sloppy, they're less predictable. It's the meteorologists being wrong a lot because their models are off. When the markets get that way, it's not the market against you. It's just that all the psychology is mixed up and there's too many headwinds, too much smart money on both sides, and it's creating volatility without follow through. Shake out, shake out, shake out, shake out, shake out. Now, if you have a bullish transition and you're reviewing it and it doesn't work, it's not that it didn't work. It's that the market transitioned again. But you're following it. So instead of getting beat up with which what most people do when trying to polish their predictive skills, trying to predict price, and that's what everybody invests money in, indicators, technology, books, everything else, predict where price is going. What is an advantage or an edge? Well, if you want to read a chart, if you want to read a market to stack probabilities, you got to get away from always having to be right. You got to know where you're wrong. That's what's important. It's not how often you're right. It's how long are you wrong for. I'll say it again. It's not how often you're right. It's how long are you wrong when you're wrong. Because if you're not wrong, you're not trading. You're not reading. And this is one concept and technique to help read the market. Not the only, but once you understand it, it could simplify a lot of stuff. You need the Dow to get through 02 for us to make higher highs. That would be my analysis. 0850 is really close to getting taken out. But if you've been long taking profits on little rallies because the Dow is weak down in here, you're making decisions based on objectivity. That maybe it qualifies an overhead resistance level you have. I know Tom had 9 quarters today. Any questions about this? As you guys are writing your questions, if you're newer, you're not familiar with B2B, you got to go to track 4. I'm going to share the screen and show you this real quick. If you go to track 4 on the Edge website, as you know, I categorize or indexed by topic. People would get that were guest hosts. You click it and you see the videos change at the bottom. Market relationships, see the videos change at the bottom. The setups, see them trade or change. Well, I did a few weeks ago the top 5 most popular. I asked people their 1 or 2 favorite, not their top 5, their 1 or 2 favorite, and then took the overlaps. And the top 5 most popular had B2B bars that I did last June 13th as number 2. We'll have Merritt Black back, by the way, maybe in a week or two to do more of a template presentation. The last couple times we had Merritt It was just kind of a banter back and forth between him and I. But we'll do one where he actually has some content, like structured, walk us through some profile stuff. So good question from Anthony. How do you transition from being wrong to getting back on the right side? One thing is not being short today, but getting on the right side is key to the participation. I'm trying to use the 12s, the 12 P&Fs, Ant, as, all right, I'm above a line in the sand. Let me just play it from one side and cut out some of the short trades that I might have. So it's like just trying to play it from one side when markets are a little tougher helps a lot. And if you're wrong, you're wrong. If you're playing from the short side, I understand. But if you're above a lot of stuff, a line in the sand, above it, I remember a guy saying this in the pit years ago. A guy got stuck short and lost a ton of money because something came out and we rallied like 300 Dow points and he was stuck short. And he was just trading it from the short side. But someone told him, hey, listen, we were above 50%. We were above this. We were above that. We were above this. What the hell were you doing short anyways? News came out on the long side for a reason. So you just got to be cautious. If you could have something to say, hey, above this area, I'm going to play it from the long side or the short side and keep a short leash on it. You put yourself in a position to not trade it from the wrong side, and that's what's key. So to help get yourself on the right side is to minimize how often you're on the wrong side. Oh, Mark is asking the question through Anthony. All right. I figured that, Ant, because it was kind of a dumb question. I figured it wasn't yours. No, I'm just joking, Mark. But it actually is a good question. So let me drill down into that a second. If you were playing it from the short side, okay, how do you get yourself on the long side? Has to be something mechanical. For me, it's like a line in the sand. Stay above it, lean towards the long side. And then look at the transitional moments and then moves back to an edge zone or support, rotation. You got to find something to minimize the time you're on the wrong side. We're going to be on the wrong side. You got to minimize that so you don't go from bullish to bearish to bearish to bullish to bullish to bearish. You're supposed to go from bullish to bearish a lot when you're working in transitional moments, but that doesn't mean you need an open position every time you're bullish. You got to be long, and every time you're bearish, you got to be short. That's not at all what this B2B concept is. It's the opposite. You don't put a trade on every opinion of who has the leash. It's helping qualify the right side. I really want people to focus on something that's going to give them. I don't want to give you like, okay, these are the two things and that's it. Don't look at anything else. But be consistent. So Anthony's using the word acceptance. If you see acceptance above a certain price, then you're bullish. That doesn't mean the bears won't have the leash at times while you're bullish. You get that? It doesn't mean they won't have the leash. They're gonna. But you wait for bullish trades to get qualified because you're bullish above. He had an acceptance area above 68.04. What market is that? Oh, in the NASDAQ. 68.04. Oh, 04 even. Okay, sorry. So he's playing it from the long side. Now, when the market's whipping around and really volatile, and this is what makes it tough for traders because they want the same thing every week and every day and every month. And markets are the opposite of that. They're not going to give you that. When they're trading good, it's because they're consistently trading similar from day to day, week to week. But when we're volatile, then you're more apt to go from bullish to bearish. Why? Because the market's taking those swings. So to minimize how often you're on the wrong side, not the wrong size, Alessandro, the wrong side, is to have something to say I'm only playing it from one side or the other, and have that be something consistent and mechanical. But there's no right answer. I can't tell you, oh, you got to have this line in the sand. Every time it's above it, you play it from the long side, and if not, that might be it. But it doesn't have to only be it. Anthony said some acceptance. It could be a profile area. It could be this. What just happened? Just big move to say, you know what? The highs are in. Rejection at 0850. The Dow has ruled the day. The Dow kept me from being cautiously bullish and long based on the compare and contrast that we were doing. And now I guarantee you the Dow had a sell stop moment that could have been identified, and it led us. And it did. Tell me that this wasn't an identifiable, be careful long, as the market could get fast and go down there, and I'll find a window and throw you out of it. You haven't watched any videos in this program. This has got to be a box. There was someone in here that said something that was looking at my charts, and I was showing them the different technology Zoom has to go to meeting with the shaded areas in the boxes. And this person said, so wait a second, you mean to tell me that's what you see? And I go, yeah. That's how you look at it, a box. I says, yes. They don't see that. If you're unfamiliar with looking at charts that way, if you weren't cautiously long or bearish in this moment, then you got to get better. If this surprises you, you got to get better. The Dow couldn't make higher highs, and the NASDAQ and the ES were. And you had a moment below there to say you're out. Now, is it too late? No, Raj, but that was a moment of predictability to get short if you thought there was rejection at 0.5. It was a moment to get out of a long based on the ancillary comparison with the Dow. Is it too late? No. These three reds are where you want to get short as close to and get out above it. Where's your risk? Forget about your entry. Where's your exit if you're wrong? It would be above 06. If you were bearish and you were thinking that there's rejection, for some other reason, the right side became the downside after all this move sideways. Overall, it wasn't, but you're seeing something to say, I think there's rejection. Maybe it's the Dow. Hey, the market's overall bullish, but there's a divergence going on with the Dow. If I see the Dow get real weak, I'm going to try to sell this S&P. Either to exit along if you're long or to get short if you are indeed bearish. Make sense? This market's not going to fly through these reds. It's going to come up shy, and then it's going to rotate down. If I'm wrong, we'll shave Mark's head this time. Yes. And the transitional moment, if that gets taken out, Raj, is when you would be out for a loser and or bullish again. Is this where's the transitional moment? That bar, right? But where did it transition from bullish to bearish? Right in here. You don't necessarily have to get short right at that price, but that's where you're wrong above it. Where do you get short? Here's where some skill comes in. You tag it to an ancillary when they're also at support, potentially. Take a look around my charts. Something moves lower, get you to jump in. You're underneath resistance. But you are following the flow a little bit better, right? Just based on your questions, I could see. This is a good session because it builds on a good session. Then the yen did it, Bruce says. I can't pull that one over her. Let me duplicate this. What do you have the yen on? What PNF, Bruce? Here's the yen. And if you're finding the stocks are leading the yen, then buy the damn yen. If you're finding through your homework, I don't like to use the word homework, but research, look at the yen. The yen got led from the weakness in stocks. Yes, heating oil and RBOB, if you have data for it. So the question was, person primarily looks and trades crude oil. Any good ancillaries for that? Those two markets. And some currencies. Look at some currencies, Christine. Take a look at different markets and see them relate. You know what I mean? Pull up some currencies, the Canadian dollar, the Australian dollar. Why those markets? Because they're commodity currencies. See if there's a good relationship. You know how you pull up good ancillaries? Asking questions about what's relating. That's one of the best ways. And then secondly, pulling in some markets you think might correlate and see if they chart similarly. You don't want them charting exactly because there's no information there. The only way you're going to get a clue is when it does something that it doesn't do, or there's a decoupling, just like between the Dow and the S up there in those highs. And then here goes the yen. Upside right there. Broke out. Tell me you're not nervous if you're shorting the yen above this area. Tell me you're not nervous. And there's a window nearby to throw you out of. Be a lot of people at the bottom of my office in the parking lot. Better be careful. Someone might turn it around and throw me out the window. And that's why I think it's hard for people to want to do this edge or they come into the trading room, and it's confusing to them because they're not looking at the chart the way I am and the way you should. They're not looking at consolidation boxes. They're not looking at where the stop started, head fakes, long up, down bars. They're not seeing it for that. They're seeing it, what makes a red candlestick? What makes a green candlestick? Nonsense. See how they held it there? They got closer here in the NASDAQ. They didn't get that close to the Dow, but they held it here and rotated down. Now, if someone were to say, well, what would get you to sell it here instead of there? You're watching the right stuff to pick better prices. That's what you got to work on. I can't give you a scientific answer. But the concepts are there. Maybe it's the NASDAQ was going up, and you want to get it closer to its resistance. Either way, you sell it here, you're on the right side of the market. However, you got to take some profits on the way down. Although this could be a nice rejectional moment or a rejection type moment. And the yen, as Bruce says, should hold as support. Kudlow's still talking. Good question, guys. Good session. Manage your risk before you start taking it and understanding these reds and greens, adjusting them accordingly. Don't you have a source, Ant? Are you at home? Oh, Russian sanctions. Additional Russian sanctions. He's a little hawkish about Russian sanctions. Oh, Mark is asking more questions through Anthony. If I beat you at basketball, Mark, will you stop asking questions? Oh, it's Mark using Anthony's name. I see. Is Anthony in here? If I can't beat you, Mark, I'll shave my head. 0506 resistance. I hope this session helped, guys. Something mechanical, but something else to work on. Exercise. It's simple to do. And help follow the leader. Find a leader instead of just watching tick by tick or getting too tick sensitive on a dome. We'll see you guys in the room. This will be posted in a few hours.